Banking domain, cards. In today's digital world, banking cards have transformed how we manage money. Whether withdrawing from an ATM, shopping online, or earning cash back on purchases, these cards offer ease and efficiency. Debit cards link directly to a bank account, while credit cards provide access to a revolving credit line. Prepaid cards allow controlled spending, charge cards require full monthly payments, and virtual cards offer added security for online transactions. Understanding these types helps consumers choose the best card for their needs. Debit and credit cards may look similar, but they function differently. Debit cards help users spend within their means, ensuring financial discipline. Credit cards, however, provide short-term borrowing, making them useful for emergencies and large purchases. While credit cards help build a credit score, they can also lead to financial strain if mismanaged. It's essential to weigh the pros and cons based on one's financial habits. The introduction of EMV technology has revolutionized payment security. Before EMV, card cloning and skimming were common fraud techniques. The microchip in EMV cards ensures every transaction has a unique authentication code, preventing data theft. Today, nearly all banks issue EMV-enabled cards to enhance consumer security. Contactless payments have become the norm for quick and secure transactions. By simply tapping their card or smartphone near a payment terminal, users can complete purchases in seconds. This technology reduces wear and tear on cards, minimizes the risk of skimming, and enhances hygiene by eliminating the need to touch payment terminals. Secured credit cards act as a stepping stone for those with limited credit history, while unsecured credit cards cater to those with an established financial profile. Both types have their benefits, but responsible usage is key to maintaining a good credit score. Chargebacks are essential for consumer protection but can negatively impact businesses if they occur frequently. Customers initiate chargebacks for reasons such as fraudulent transactions, undelivered goods, or billing errors. To minimize chargebacks, merchants should offer transparent pricing, responsive customer service, and secure payment processing. While Visa and MasterCard operate as payment processors connecting banks and merchants, American Express and Discover handle both issuing and processing. Amex is known for premium rewards and higher merchant fees, while Discover offers cashback and lower global acceptance. Understanding these networks helps cardholders choose the right card based on perks, acceptance, and fees. Virtual cards provide an extra layer of security for online shoppers. Since each virtual card has a unique number, even if stolen, it cannot be reused. This makes them ideal for subscription services, one-time purchases, and preventing unauthorized charges. Banking security has evolved to combat rising cyber threats. From one-time passwords for authentication to AI-driven fraud detection, financial institutions continuously enhance security protocols. Cardholders should also be vigilant by checking statements regularly and reporting suspicious transactions immediately. PCI DSS compliance is crucial in the banking and payments industry. It ensures that financial institutions, merchants, and service providers follow strict security measures to protect customer card information. For example, companies must encrypt card data, implement firewalls, and restrict employee access to sensitive information. Failure to comply can lead to breaches, fraud, and penalties imposed by regulatory bodies. Banks and payment processors conduct frequent audits to ensure compliance with these standards. KYC plays a vital role in ensuring that banking cards are not issued to fraudulent individuals. When applying for a card, customers must provide valid identification documents such as passports, driver's license, or utility bills. Banks use advanced AI and machine learning to verify identities and detect potential fraud attempts. Strong KYC policies help financial institutions maintain trust, security, and regulatory compliance. Card fraud continues to evolve as cybercriminals develop sophisticated techniques to steal card information. For instance, skimming devices placed on ATMs can secretly copy card details, leading to fraudulent transactions. Similarly, phishing scams trick users into entering sensitive banking information on fake websites. Banks counter these threats with AI-driven fraud detection, real-time monitoring, and multi-factor authentication to protect customers. Tokenization is an advanced security technique widely used in mobile payments and digital wallets. Instead of storing actual card details, a unique, random identifier is generated for each transaction. For example, when a user pays via Apple Pay, their real card number is never shared with merchants, making it nearly impossible for hackers to steal data. Many businesses adopt tokenization to enhance customer trust and transaction security. Banking card operations must comply with global and regional regulations to ensure fairness and security. For instance, GDPR mandates that businesses obtain user consent before processing card-related data. Similarly, in the US, the FCPA limits consumer liability for unauthorized charges, and TILA requires clear disclosures of credit terms. Banks must stay updated with regulatory changes to avoid legal risks and maintain consumer confidence. AML regulations require banks to closely monitor credit and debit card transactions to detect potential money laundering activities. For example, a sudden high-value transaction from a low-income account may trigger a red flag. Financial institutions use advanced AI models to identify patterns in spending, flagging transactions that deviate from normal behavior. Additionally, AML compliance teams file suspicious activity reports to regulatory authorities when necessary. Financial institutions cannot afford service disruptions, as millions of transactions occur every second globally. Banks use geographically dispersed data centers to prevent downtime. Load balancing ensures that if one server experiences high traffic, transactions are rerouted to another. Additionally, cloud-based payment gateways offer faster processing speeds, improving overall efficiency and customer satisfaction. Banking cards are convenient but often come with multiple costs. Annual fees apply to premium credit cards, but some banks waive them if a minimum spend is met. Transaction fees for international spending can be up to 3% per transaction, depending on the issuer. Late payments on credit cards can lead to hefty penalties and increased interest rates, so it's crucial for customers to pay on time. Cash advances are costly because they come with immediate interest charges, often higher than standard purchases. Balance transfer fees are for transferring debt from one card to another. And finally, some prepaid and debit cards charge a fee for long periods of inactivity.